Hey everyone, slow down for a second. While most of the internet is chasing headlines that won't matter next week, something quieter is happening inside the US banking system, and quiet is exactly how serious problems like to arrive. A few nights ago, a routine regulatory filing dropped into a federal database. No press conference, no push alerts. Just another quarterly call report, one of those documents most people never open. But if you actually read the deeper schedules, you can find numbers that don't just look a little concerning. You can find combinations that don't work at today's prices. Here's the setup. A regional bank reports what looks like a normal quarter, assets, deposits, capital ratios, everything presented in tidy lines that feel reassuring. Then you scroll further down and see two things sitting next to each other like a lit match near gasoline, a large block of unrealized losses in the securities portfolio, and a concentrated exposure to commercial real estate. On paper, the institution may still appear well capitalized. In economic terms, if you marked certain assets closer to where the market would price them today, the story can flip. Not "we're under pressure," more like, if the losses were forced to be recognized quickly, equity could be wiped out. And that's the part most people don't understand about modern banking risk. A bank doesn't need to lose half its assets to fail. It only needs to lose enough to erase its equity cushion. Equity is thin by design. When the cushion is thin, the speed of confidence matters more than the size of the building. This is not about one bank. It's about a pattern the system has been carrying since rates jumped, a structure that can look stable right up until the moment it isn't. Today is January 20th, 2026. What I'm about to lay out isn't a prediction or a rumor. It's balance sheet mechanics, how stress moves through securities, commercial real estate, deposits, and confidence in a digital banking world. To understand why this can sit in plain sight without triggering an alarm, you have to understand one of the most misunderstood accounting categories in banking: held to maturity, or HTM. Here's the simple version. Banks hold securities, treasuries, agency mortgage-backed securities, and other high-quality instruments. When rates rise, those older low-yield bonds fall in market value. That drop creates losses. But if the bank labels a big chunk of those securities as HTM, it doesn't have to mark them down to current market prices each quarter the same way it would for available for sale. The loss is real, but it can remain mostly hidden as long as the bank doesn't sell. Think of it like refusing to check what your house would sell for because you're not moving. Fine, until you need cash. In banking, needing cash often means deposit outflows. And deposit outflows are where accounting turns into reality fast. This is the core lesson from March 2023. Silicon Valley Bank didn't implode because it had a portfolio full of junk loans. It imploded because it owned long-duration assets purchased in a near-zero-rate world, funded by deposits that could leave instantly. When withdrawals accelerated, the bank had to sell securities. The unrealized losses became realized. And once realized losses eat through equity, confidence doesn't slowly fade, it snaps. Now take that same vulnerability and add a new stressor that doesn't heal on a calendar: commercial real estate. A government bond that drops in price can still pay coupons and return principal at maturity. But an empty office building doesn't mature back to full occupancy. A refinancing problem doesn't magically disappear because the Fed cuts rates a little. Real estate depends on rent, occupancy, tenant demand, and investor appetite, things that can change structurally. That's why the idea, rate cuts fix everything, is only partially true. Lower rates can reduce the pressure on bank securities and improve refinancing math at the margin. But they don't refill floors that tenants gave up. They don't reverse years of remote and hybrid work. They don't instantly restore valuations that were propped up by cheap debt. So the system is sitting with a trapdoor. As long as the bank isn't forced to sell, losses can stay invisible. But the moment liquidity gets tight, invisible becomes visible, and visible becomes contagious. Now let's talk about where the pressure is actually building, because it isn't evenly distributed. It's concentrated. And concentration is what turns manageable into failure. Commercial real estate, CRE, has been a favorite category for many regional and mid-sized banks for years. It offered yield when safer assets didn't. It offered relationships, collateral, and the illusion of stability because valuations seemed to drift upward for so long that risk started to feel theoretical. That era ended. And the stress isn't abstract. It's specific. Offices are the center of gravity. Not every market, not every building, but enough to matter system-wide. Remote work didn't fully revert. Hybrid schedules became normal. Companies downsized footprints. Lease renewals came in smaller. Vacancy rose. Rent growth softened or went negative in some corridors. And as net operating income weakens, values reset. Here's the key: delinquency is a late-stage signal. Before a loan goes delinquent, there are months of quiet negotiations, extensions, interest reserves, modified terms, workouts with polite names. When delinquencies show up in the data, stress has already been present for a while. The market is simply catching up. Retail adds a second pressure point. Yes, some shopping centers thrive, but a large portion of older, lower-quality retail is structurally impaired. E-commerce permanently reduced the amount of space the economy needs. Repurposing is expensive and slow. In weaker areas, the exit price can be brutal. Multifamily is the third area people underestimate. Housing demand exists, but the financing structure still matters. Higher rates, pockets of oversupply, slowing rent growth, insurance and tax costs, and tighter underwriting can all compress cash flow. Even modest increases in delinquencies matter when the exposure base is huge. And then comes the maturity wall. A large wave of CRE loans, especially balloon loans originated in the cheap money era, face maturities through 2026 and beyond. When those loans come due, borrowers need refinancing. Refinancing requires appraisals that support the loan amount. But appraisals depend on cap rates, and cap rates moved higher. That pushes values lower. Lower values mean borrowers must bring cash to close or default. That's the mechanical trigger. A market can talk about stress for years. A maturity date forces decisions. Now layer on the banking reality, some institutions hold CRE exposure that is very large relative to their capital base. That ratio matters more than the headline number. A 10% impairment in a concentrated book can be fatal if equity is only a thin slice of total assets. That's why a calm looking call report can hide a dangerous structure. At this point, people hear losses and assume the story is just about write-downs. But losses alone don't create a banking crisis. Contagion does. Banking is confidence. It's the belief that your money is available on demand. Once that belief wobbles, even slightly, behavior changes instantly. In the past, runs were physical lines outside branches. Today, runs are digital, silent, fast, and scalable. Millions of transfers can happen in hours. Payrolls can be moved. Treasury teams can sweep funds. Consumers can push a button and move deposits to a perceived safer institution before lunch. And once deposit outflows start, a bank's options shrink quickly. Borrow against collaterals if lines are open and collateral qualifies, raise expensive funding if markets allow, or sell assets, which forces recognition of losses. This is where the combination of securities losses and CRE stress becomes dangerous. Securities losses weaken flexibility. CRE stress weakens asset quality. Depositor behavior tests liquidity. The three together can turn a normal quarter into an emergency weekend. Now zoom out further. CRE risk doesn't stay on bank balance sheets. Loans are packaged into CMBS. Exposure sits inside insurers, pension funds, REITs, and private credit vehicles. When valuations reset, damage spreads sideways through the financial system, even if the original loan isn't held by a bank. That's why you'll sometimes hear big numbers thrown around. Trillions, not because banks will lose trillions directly, but because system impact can stack across layers. Think of the risk in 4 layers: when direct losses, defaults, restructurings, charge-offs, securities sold below cost; 2, attainment costs, FD resolutions, emergency liquidity programs, guarantees, special facilities; 3, spillover losses, markdowns, and liquidity stress across non-bank holders and vehicles tied to CRE. 4, economic drag, credit tightening leads to fewer projects, slower hiring, weaker consumption, higher defaults, a feedback loop. If you combine all 4 layers, multi-trillion outcomes aren't automatically doomsday. They're within the plausible range of system-wide consequences during a major adjustment cycle. The system can survive losses. What it struggles to survive is speed, because speed breaks confidence, and broken confidence forces actions that make losses real. So what does this look like in real time? It rarely arrives as one dramatic headline. It arrives in phases, and then suddenly it's everywhere. Phase 1 is already visible: price discovery. A high-profile office property trades at a price that feels impossible compared to a 2019 appraisal. That sale becomes a comparable. Comparables reset appraisals. Appraisals reset refinancing terms. Refinancing terms trigger equity gaps. Equity gaps trigger defaults. This is how a few deals become a pricing regime. Phase 2 is the weekend event. A regulator steps in after markets close. The language is calm: orderly resolution, bridge bank, deposit access restored. But the translation is simple: the institution could not continue under the old assumptions. Losses could no longer stay hidden. Phase 3 is the Monday morning scramble. Most people don't panic from the announcement itself. They panic from friction. A portal doesn't load. A wire gets delayed. A debit card gets declined. Payroll posts late. These problems are often temporary, but in a stressed environment, temporary feels permanent, and people don't wait for explanations when moving money is one click away. Phase 4 is the silent run. There are no crowds, just transfers. Funds migrate from regional banks to the largest banks, to government money market funds, or into treasury bills. Even if the biggest institutions are fine, the act of fleeing destabilizes the banks being fled from. Phase 5 is the refinancing crunch. As 2026 moves along, maturities hit like deadlines, not headlines. Borrowers who assumed rates will fall enough run into tighter underwriting and lower valuations. Extensions buy time, but not solutions. More loans roll into special servicing, more banks increase reserves, more capital gets consumed by reality. Phase 6 is policy response. If stress broadens, a new facility appears, always with a neutral name. The purpose is familiar: stop forced selling, lend against collateral, slow down the run dynamics, and prevent a cascade. The cost is also familiar: risk transfer and long-term consequences. Acute panic gets contained, but structural damage remains. Then comes the least dramatic phase, and often the most economically painful: the slow pullback. Surviving banks reduce risk, lending tightens. Projects get delayed. Small businesses feel it first: job growth slows, defaults rise. That feeds back into banks again. This is how a financial problem becomes a recession problem, not overnight, but through a tightening spiral. Now let's bring it down to practical reality, without fear and without theatrics. This is about reducing single points of failure in your financial life. First, understand FDIC coverage. The standard limit is $250,000 per depositor, per insured bank, per ownership category. That means the structure matters. Individual accounts, joint accounts, certain trust accounts, and retirement accounts can be treated differently. Many people assume, I'm covered, without checking how their accounts are titled. Secondly, separate solvency risk from access risk. Even if you're insured, bank resolutions can create short disruptions, temporary holds, card interruptions, delayed wires. Usually these are resolved quickly, but usually is not a plan if you need payroll to hit on time or a rent payment to clear on a Monday morning. Third, build redundancy. One additional banking relationship can reduce stress dramatically. A backup checking account. A second credit card at a different institution. Tested transfer links. It's boring until it isn't. Fourth, if you run a business, diversify operational cash. Payroll concentration is a common failure point. If all operating cash sits at one institution, your risk isn't just loss. Your risk is interruption. Consider splitting cash between multiple banks, using treasury bills for excess liquidity, or using insured cash sweep services where appropriate. Talk to your advisor. This is education, not advice. The fifth, if you're a property owner facing a 2026 maturity, start early. The best time to negotiate is before the calendar forces it. Bring updated numbers. Understand current valuation ranges. Explore partial paydowns, partner equity, or asset sales with time on your side. Waiting compresses options and worsens terms. Sixth, for investors, map indirect exposure. You may not own a building, but you might own a REIT, a fund holding CMBS, or an insurer exposed to CRE credit. Liquidity can disappear precisely when you want it. Knowing what you actually own matters more than knowing what you hope it is. None of these steps require panic. They require clarity. The goal isn't to predict a collapse. The goal is to be resilient if a weekend event creates a Monday morning mess. Here's the final takeaway. The earliest warning signals in a banking stress event often aren't headlines. They're small signs that confidence is starting to wobble. Watch these distressed CRE sales in major markets, not because one sale breaks the system, but because comparables rewrite the valuation framework for everyone else. 2 refinancing standards, not just interest rates. A rate cut helps, but if lenders demand lower leverage and higher coverage ratios, many borrowers still can't refinance at old balances. 3 deposit migration patterns. When deposits consistently flow from smaller institutions to the largest banks or to government money market funds, that's a quiet vote about perceived safety. 4 funding behavior. Banks competing aggressively on CD rates, leaning on brokered deposits, or using more wholesale funding can signal stress beneath the surface. 5 new emergency programs. When officials roll out a temporary facility, the name will sound calm. The reason is urgency. These programs are designed to slow cascades, useful but never free of trade-offs. 6 operational friction. Repeated app outages, transfer delays, unexpected limits. Sometimes it's harmless IT. Sometimes it's a sign the institution is managing liquidity and volume in real time. Context matters, and above all, understand the difference between accounting solvency and economic solvency. A bank can look fine under rules that allow certain losses to remain unrecognized, but confidence doesn't operate on accounting categories. Confidence operates on speed, access, and narrative can flip in a weekend. The point of this video isn't to scare you. It's to remind you that modern banking runs on trust, and trust can move at internet speed. Reduce single points of failure while everything still works. Know your insurance limits. Maintain backup access to liquidity. And if you're exposed to commercial real estate, directly or indirectly, treat 2026 like a year where deadlines matter more than opinions. Because the most dangerous phase of a financial cycle isn't when everyone is yelling. It's when the math is breaking quietly, and the crowd hasn't noticed yet.